Hi traders, today we're going to discuss a very simple swing trading strategy that can be very easy to understand and very logical to implement. Not only are we going to discuss a strategy, but we are also going to discuss when to enter, which stocks to enter, and also the exit and position sizing criteria. So as I told you, this is a swing trading strategy. That means you'll be buying stock in cash and you'll be holding it for more than one day. That is, it is not going to be an intraday trading strategy. It is going to be a swing trading strategy where you hold for multiple days, maybe even more than a week, and then realize your profit. You're going to book your profit. It is neither intraday trading nor is it long-term investing. So what are the benefits here for swing trading? Yes, the risk is lower. You do not have to be so immersed in the charts and price levels for the entire trading day. You can maybe keep price alerts, or maybe you can set even GTT orders. That means good till triggered orders, which does not even require any input from your side during the market hours. And as you know, intraday trading is not something you can easily master. It will take time for you to understand the nuances of it. This swing trading strategy is very much more easy to understand. To get the logic of it into your heart and mind, it is more simple. So what are we going to do here? We are going to trade with the big players. We are going to understand when people are making big positions, maybe without even much changes in price. Right? So when these big positions are made, then we'll decide and enter at a level where a breakout happens. So again, to be more clear, we try to follow silent big players in the market and see when they're creating big positions for swing trading. Right? Not for intraday trading. When they're creating big positions specifically for swing trading, and following that, we'll try to enter when there is a confirmation of bullishness. So let's get started with the video. The name is Ajay Dutt. Welcome to Market Feed. So let's get started. The strategy works on the basis of delivery percentage. Right? If you don't know what that is, I'll break it down for you. So first we have to understand what is volume in the market. So let's assume that you are a buyer and you're looking to buy nearly 10 stocks of Reliance. And me as a seller on the other side, I'm looking to sell my 10 shares of Reliance. So here there is a buyer, that is you. Here there is a seller, that is me. And we are both trying to come into the stock market and arrange a deal. So when the trade happens and the share exchanges hands, what is a volume here? Some people might assume because a buyer was willing to buy 10 stocks, the seller was willing to sell 10 stocks, that the volume is going to be 10 plus 10, 20. But no, it is not like that. The volume is going to be the number of shares that were exchanged between you and me. That is only that 10 shares which we bought and sold is going to be shown as a volume traded. So now that you understood volume, let us look at delivery quantity and delivery percentage. So in any given day on any stock, there are a lot of trades happening. Like you and me just had the 10 share deal of Reliance. There are lakhs or crores of people making transactions every single day, and that too, each transaction worth being lakhs or crores in themselves. So when you're in the market, even you might have noticed that there are two types of trades which generally happen. One which you square off intraday, and these are called intraday trades, right? Very simple. And the second one are called delivery trades, where one person's shares in his or her demat account gets transferred to another person, and these are called as delivery transactions. And the number of shares which have been transferred from one demat account to another on a particular day is known as delivery volume. So yes, there is intraday volume, there is delivery volume. Anybody who squares off intraday, that comes under intraday volume, and anybody whose share transfer really happens between one demat account to another, there we call it as delivery volume. And at the end of the day, this intraday volume plus delivery volume is your total volume for the day, right? So hope that was not too complicated. If not, let us move ahead. So one last term to look at, which is the most important for this strategy, it is a delivery percentage. So when you're looking at the delivery volume and dividing it by the total volume of the day, what will you understand? Out of the total transactions which happened today, what percentage of transactions were actually delivery transactions? That is what you will understand. And this is called as delivery percentage. So in a particular day in a stock, if the delivery percentage is high, what does that indicate? It means that a lot more people took delivery of the shares into their demat account and they did not square off their order like an intraday trade. They actually took that trade home. So this term is a basic building block of our strategy, which is delivery percentage. Logically, think about it. When someone takes delivery of a share, two things can happen. Either they are a very intelligent buyer and they're trying to accumulate stocks before it starts moving up even further. That's why they did not square it off intraday. They feel like it will be trading higher and higher in the coming trading sessions. But there is another case as well. In the case of a losing intraday trader who bought stocks with the intention of squaring off at the end of the day. But what happened? Let's say he bought 300 shares of Tata Motors on a particular day by 10 a.m. and he was willing to square it off by 3 p.m. in profits. But by 3 p.m. the stock had fell 2% and he was no longer willing to accept that loss. So he would take delivery of that stock, which I do not endorse, but it would technically be a bad trade. He took delivery just to avoid a loss. So delivery percentage would mean either of these two, either an intelligent buyer who expects that the stock would keep on moving up in the coming days, or even a dumb buyer who did not want to digest that losses for the day and instead took delivery of the share. So yes, there is some opportunity here. If you're finding that person who's trying to make an intelligent trade or who has the power to move that stock upwards and you trade with them, then it's a good sign. And if you're able to take that trade with a minimal SL and a good risk to reward ratio, it would mean that you would end up with good profits in the long term. So this is a tried and tested strategy. I know a lot of people who trade with this very strategy and they've been doing it for multiple years successfully, not just 1 or 2 or even 5 or 10 years. I know people who have been using this strategy who have traded in the Indian markets for more than 10 years and are still using this as one of their primary strategies. Right? And yes, we'll explain that very quickly by getting into the screener here. So let's come into the StockX platform. I'm sure most of you would have tried it out here and there earlier in your life, but we are showing it here for the first time. And again, this is not a paid advertisement. I'm just showing you a tool which I feel is the most simple, it is free, and the most effective tool for you for this particular scenario. Also, we run virtually no advertisements on this channel compared to any other finance channel. So if you like that concept, get subscribed. So yes, moving back into the screener. So the name of the screener is Volume and Delivery Scans. I'll put the link right in the description and in the pinned comment so that you can directly reach this page. So once you reach here, you have to put the filter as well. If it is not yet filtered, you have to go to Buy Importance and select Major Stocks. So what just happened here? You just selected significant stocks so that you can filter out very bad stocks as specified by StockX. But also you can go to the filter and you can select any of the different filters that you want to, right? You can select Nifty 500, Nifty 200, Nifty FNO, or just all NSE stocks, right? You can do any and all of that here. So I'm just going to select major stocks here. So now you have identified the stocks which are showing high delivery quantity and percentage. Right? So that is done. The first screening part is done. So now we're going to just show you a back-tested result so that you can understand a good case as well as a bad case when you're looking into the screener. Right? So first let us check out the stock which is Shoppers Stop. So we've gone to 10th April and we've got the data for that date. So when we're clicking on the Shoppers Stop stock, we'll see what was the history, the delivery percentage history for this stock over the last multiple days. So when you're looking at this 10th April date, you can see that there was abnormally high trading volume as well as very high delivery percentage in that stock. Earlier, this stock used to have a delivery percentage of 48, 49, 50%, but on this very specific day, it had very high volume as well as 86% delivery. That means out of all the trading volume that day, 86% stocks were taken home. They were not squared off. They were added to some person's demat account or multiple persons' demat account for that matter. So let us also go and check out 361 WAM, which is a wealth and asset management company. So you can see the data for that company here as well. So on 8th April, 9th April, 10th April, and even 12th April, there is very high volume and unusually high delivery percentage on this stock. So yes, we have added these two stocks to our watch list. Right? This is all that we are going to do. So yes, as I told you earlier, I'm not just going to give you a screener. I'm going to give you a complete strategy, including entry and exits, and how to differentiate between a bad trade and a good one. So first, let's go check out the stock which is called as Shoppers Stop. Right? So on 10th April, you get this notification saying that there is unusually high volume on the stock and there is unusually high delivery percentage as well. So what do? You go there and you think about getting into a trade. What would have happened? So this was a daily candlestick made by the stock on the 10th of April when you got that alert, right? And once if you had entered into that stock, it would have gone down by nearly 5.5 to 6%, thereby hitting all of your stop losses and making you a loss in that trade. Now let's go to the second case, which is 361 WAM. So on the 10th of April, that is this day candle, you got this alert at the end of the day. That's right, you get this alert, or you can run this screener only at the end of the day. That's when you get the delivery data. After all the intraday trades are settled, that's only when you get the data. So you got the data and you went into the stock very much interested and you took a blind entry, right? Just talking about blind entry here. What would that have made you at the peak of today, right? I'm being very highly optimistic here. At the peak of today's trade, it would have, this specific trade would have made you nearly 22% profits in under 1 week. So how do you, at least with some high confidence, I'm not saying 100% profit strategy or anything, guys, but with some confidence, select this particular stock instead of the losing stock that we entered earlier. Now here is where the entire package comes in. First, let's discuss the entry criteria. The entry criteria is going to be very simple here, guys. Listen carefully. So if on a particular date, that is 10th April, as we are discussing here, you get this alert and you're thinking, where should I be entering this stock, or if I should be entering this stock at all? So what you should be doing is marking the high of that particular day's candle, and if that candle's high price is crossed by the stock, then you should go ahead and enter it. If it had a gap up opening, you should wait for that specific level itself. You should not enter it then, but if that specific level is touched and it's crossed barely, then you should be entering that trade. That is a major difference between this particular trade on 361 and the other trade on Shopper's Stop, right? So Shopper's Stop, if you're taking the day of 10th April, it never crossed the high of that candle. It just kept on moving down, down, down. But on this particular stock, which is 361 WAM, the chart is very clear. Positions were made by big players and you can see the stock shooting up. Then at the end of the day, you'll see it as some news which comes out, as some market action which comes out. Anything can happen. But the indication that we saw earlier, it is just telling us that good players or big players in the market are making big positions in that stock. And one extra thing that you have to note for this entry condition, after you add the stock into your watch list, if this high is not crossed within the next 5 trading days, that means there is not much strength in the stock, right? These big players that you thought took a position, they might not be real big players as you thought. So if this level is not crossed for the next 5 days, do not enter the stock, right? You can just let it be. You'll find a lot more stocks coming your way. So now that we understood the entry condition perfectly, screen the stocks which have high delivery percentage and high volume compared to all of their previous days. Once you're done with the screener, you just select the high of that day, particular day, and on any of the next 5 trading days, if and when that high is crossed without a gap up, then you can go ahead and take the entry. But as we have discussed always, it is not just about the entry, it is about your trade plan. When are you planning to book your profits? When are you planning to exit that trade with a stop loss? That is a question which we'll be getting into next. So the trade plan is going to be very simple, which is first you'll define your stop loss. As I've told you multiple times, the first part of your trading plan is going to be your stop loss. So your stop loss is going to be under the low of that specific candle which we were always talking about. So we crossed or we entered a trade when the high was crossed. If that candle's low is breached on the lower side, then you have to go ahead and exit that position. Your view is no longer right. You may go into further and further losses. So do not keep holding on to that trade. You can peacefully exit with the knowledge that you'll get better positions next time. So in this stock, what would have been your SL? It would have been nearly just 2.85%. But let's be a bit more realistic, give it a bit more breathing room and take a 3.5% SL. Try to be a logical trader here. What is a possible risk to reward ratio that you can get here? I would say you should go for at least minimum of 1:1.5, or as you can see on the screen here, your risk to reward ratio by using this tool. It is called as a long position tool. You can come find it here on TradingView. You just have to click on the specific point which you're going to enter and you can adjust the target and stop loss prices here. So once you're using this tool, you can see that my risk to reward ratio is 1.77. You should at least try to maintain a risk to reward ratio of more than 1.5. Ideally, 2 would also be great. But in this case, you can see that there is a very strong resistance coming up for the stock, which is the 52 days high. So So in that case, you should be keeping your target near that 52 weeks high. There is a high chance of rejection from that level. So you've defined your target, you defined your stop loss, and you have entered your trade. And the perfect way to look at any swing trade is to maximize your profit from that particular winning trade. So when you're going into a winning trade, you should be trailing your stop loss. That means if it is hitting your target, you can book some quantity. I ideally book 50% of my entered quantity at my planned target, and I trail my stop loss. So if my stop loss was around 716 for the stock, I'll trail my stop loss above my entry level to nearly 743. That means even if this position goes back down, even if it does not continue rallying, I'll end up making some profits from the stocks which I sold, but I'll still not go into any losses, right? I'll be exiting the rest of it at break even. Now, what all have we learned? We understood to identify a stock, we understood when to enter it, we understood when to exit it, and we also understood how to trail your stop loss. And now the only question that is remaining is how much money should you be putting into that stock? Again, this is not something you should think lightly over. This is a very important part of this framework or any swing trading framework, right? Wherein you have to think about how much money you're going to be putting into that stock. And for that, you have to use MarketFeed Swing Trading Calculator. It is free to use, and the video on how to use it, I'll link it here. You can go check it out. I've explained it very much in depth. So ideally, you should not be taking more than 2% risk of your capital. You should be at least having enough money to take 5 positions at the same time, and the calculator will tell you intelligently how many quantity of stocks to buy. But yes, as always, the most important parts of any strategy would be your mindset and your confidence on that strategy. So try putting in smaller and smaller quantities or smaller capital before you're willing to scale up, and then try to build confidence of this strategy. The logic, as I said earlier, it is very simple and very easy to take in, and that's what I like the most about this strategy. And once you have the confidence on this strategy, you'll automatically develop that trading mindset. You'll book your stop losses at the correct time, you'll trail your stop loss at the correct time, you'll book your profits, you'll not hold on to a trade for longer than needed, and you'll not be exiting a trade just because you're scared, just because it didn't hit your target, or your SL does not mean it's a bad trade. Maybe it will consolidate for a few days and eventually go up either to your target, hopefully to your target, right? So with that confidence, you'll be building the trading mindset and psychology as well. So if all is done, do let me know in the comments down below if you like this video and this strategy. This is Ajay Ajit signing off. See you again in another video. Bye bye.